Good almost afternoon, everyone. I just want to pop in and let you know that we will be starting momentarily, and we look forward to our program. Hello, everyone. Thank you for joining us this morning for this webinar program specifically for people who advise their clients on wealth and legal and accounting matters and charitable giving. We're delighted you've joined us today, and I'm happy to welcome you on behalf of our colleagues and collaborators today. We have our friends at the Valley Community Foundation and Sharon Closius, the CEO. And we have Lisa Stanger, the Executive Director of the Jewish Foundation for Greater New Haven, joining us today. And you're going to see more of them in our program today. In talking about our retirement matters, we're delighted to have with us, the old saying about profit in your own land. Well, we have a prophet from a bit afar and a prophet from our own land. So we're joined today by Mike Diadio from MARCUM LLP, our local accounting firm, and Laurie Ingwersen, who she's our prophet from afar from the Harvest Group in Waltham, Mass. So without delay, I'd like to get you right to Laurie and her comments. Please put any questions you might have. You can use the chat function and direct any questions that you might have to the Q&A. Thanks so much.
Well, hello, everyone. Thanks for joining us today on this webinar for retirement planning and the Secure Act 2.0. We're going to discuss the important topic that affects every one of us, which is retirement. And regardless of how old you are or where you are in your career, it is crucial to plan for your retirement. We'll be discussing various aspects of retirement planning, the accumulation phase, the distribution phase, and the changes to both of these phases with the Secure Act 2.0 that was passed very late last year. Retirement planning can be overwhelming and confusing, especially for those who are just starting. So we believe with the right information and guidance, everyone can plan for a comfortable and stress-free retirement. A little bit about the Harvest Group. We are a wealth management team in Waltham, Massachusetts, and we work with our clients to help them achieve financial peace of mind. And we do that through our process that we call the Harvest Wealth Management for Life. And that includes lifetime financial planning, investment management, lifetime financial management, and relationship management. So in retirement or planning for retirement, there's two distinct phases, the accumulation phase and the distribution phase. So the accumulation phase is going to involve saving and investing for a long period of time, often decades. And it can be challenging because it requires discipline and consistency and a long-term perspective. But it's also exciting as you watch your retirement assets grow. The distribution phase involves taking that money that you've saved and now using it to fund your retirement expenses, which are for periods of many, many years. So this phase is often very challenging as well because it requires the management of your retirement income to make sure that it lasts you throughout your lifetime. So we have a poll question here, and that question is, what is more complex, the accumulation phase or the distribution phase? So I'll give you a second to answer that. So I think in general, some people find the accumulation phase of retirement a little bit more or a little easier because it's more straightforward. It has a longer time horizon often. But the distribution phase could be easier as well because it offers you more flexibility and control over your finances. So I think that it's just really dependent on your individual circumstances. But I think the most important kind of process as you're going through this is to work with your professionals, to work with CPAs, to work with the financial advisors to make sure that you have a plan. So talking about the accumulation phase, there have been many changes with that Secure Act 2.0. So we're going to talk about the retirement plan contribution changes, changes to 401ks and 529 plans with the Secure Act, and what are some ways that you can help your clients accelerate their retirement savings. So the retirement plan contribution changes, these are really important to keep in mind. And we have a great financial worksheet, it's like a cheat sheet. So if anybody is interested in receiving that, you can just send me an email afterwards. My contact information will be sent out. But for 401ks, 403bs, and similar plans, the contribution limit has increased to $22,500 and the catch-up contribution $7,500. For simple plans, participants are now going to be able to contribute $15,500 and the catch-up contribution is $3,500. And for SEP plans, the contribution limit's increasing to $66,000, but the income restrictions still remain. So some changes to the 401k, these are happening in the years to come, but in 2025, all new 401k and 403b plans will have an auto enroll that for employees, and employees of course can opt out, but I think the good thing is that with this is that you'll have a lot of people that typically may not sign up for a 401k because they're not really sure what it is or how it works. They'll be automatically enrolled. In 2025, there'll be additional catch-up contributions for those aged 60 to 63. So we'll go up to 10,000, which is will be indexed for inflation. And a big change in 2024, employers may match student loan payments that are made by the employee. So whatever amount the employee has paid towards those student loan payments, the employer can match that, but it must be directed into a retirement account. Big change with 529 plans. This is actually kind of exciting because a lot of 529 plans will have unused balances and people don't know what they should do with those balances if they're not going to be used for school. So starting in 2024, those unused 529 plan balances can be rolled into a Roth IRA in the name of the beneficiary. There are conditions that must be met, and that includes a 15-year holding period for that 529 plan, the annual Roth limits, and of course the lifetime limit of $35,000. So something to keep in mind if your clients are asking you what to do with those balances. So let's talk about some ways to accelerate retirement savings. So of course here we're showing you the limits of the different various plans. And in the middle here, you have the cash balance plan. So cash balance plan is a defined benefit plan that can stand alone or be combined with a 401k profit sharing plan. And the contribution limits have increased to $265,000 annually. This is a great plan for any of your clients that have high cash flow and are looking for some more disposable or have the disposable income. They're looking for some more ways to defer taxes. So here's a little cash balance one-on-one for those that are not aware of this. They are a standalone plan that can be combined with a 401k profit sharing. It is a pooled plan, and you do need to work with a third-party administrator on that. And they can actually be used to benefit key employees. So they are a way to reward some employees and put a vesting schedule on to, you know, have those golden handcuffs, if you will, for your highly compensated employees. And there's a little example here. So let's say you have a doctor as a client. They have W-2 compensation of 150,000, qualified business income of 300,000. So on their tax return, they are showing 450,000 of income, taxable income. If you were to add the cash balance contribution of 175,000, they still have, of course, the W-2 compensation of 150,000. That qualified business income is reduced to 125,000. If they are eligible for the QBI deduction of 25,000, that reduces their taxable income to 250,000. Now, there are some requirements with the cash balance plan. The IRS wants to see permanency, so there's a minimum of a 3-year period of time to contribute to it, maximum of a 10-year period of time, which after that time, the funds can then be rolled over into a traditional IRA. So I have another poll question here. Can anyone participate rather in a cash balance plan? Give you a second to answer that. So the answer is yes, anyone can participate. Does it make sense? Well, that's where you have to get a census from your clients, and we can put together an illustration, or a third-party administrator can put together an illustration for you to determine if it is the right plan for you. If you have a younger business owner with several older employees that have a high income, it may not make sense for that business owner. They may have to contribute a lot more to those highly compensated older employees versus an older business owner, a sole proprietor, or even a family business, where you can really carve out a great contribution to those owners. So let's shift gears and talk about the distribution phase of retirement. So the distribution phase, there are changes with the Secure Act, with the required minimum distributions. This is really important to keep in mind. So if you turned 72 last year in 2022, you're going to remain on your required minimum distribution schedule. But if you turned 72 this year through 2027, you can now delay taking your required minimum distribution until you turn 73. And then you can see that it extends out to age 75 if you turn 72 in the year 2030 and beyond. So very important to keep that in mind. Another big change, the required minimum distribution penalty. So if you didn't take your required minimum distribution, you used to be penalized 50% of that RMD. That's now been lowered to 25%. And for qualified charitable donations, you are now allowed a one-time up to $50,000 QCD to a split interest, either a CRAT or a CRUT. And that is solely funded by the QCD. The QCDs do count towards your required minimum distribution, and that 100,000 limit is going to be indexed for inflation. And keep in mind with this, of course, you have to be 70 and a half or older. So, so when you're in the distribution phase, of course, a lot of people are dependent on their IRAs for their income. And if they retire earlier than 59 and a half, they, of course, are going to have penalties if they withdraw from that IRA. So very important to make sure that you keep that in mind, because when you're doing the retirement planning, you want to make sure that they have assets outside of the IRA to supplement their income needs before they turn 59 and a half. course, once you reach 59 and a half, there are no withdrawal restrictions. And as I mentioned in an earlier slide, the required minimum distribution ages have changed. So what we're looking at on this slide, we're talking about income during retirement. So giving you an example of a couple, they are both 72 years old. They have $2 million each in their IRAs, and they have $1 million in a joint account. So each of the colors representing their different income sources. The light blue is representing their Social Security. The green is representing their required minimum distributions. And then the blue is representing taxable investment earnings. So one of our goals with our process with our clients is to reduce their taxes over their lifetime. So when you have significant assets in the IRAs, we know that your required minimum distributions are going to be pretty large and could be extremely large when they're in their 80s and their 90s. So in this case, their required minimum distributions are representing the majority of their income. Their lifetime taxes are estimated to be 3.3 million. And then the end of the plan investment assets are 9.3 million. So we want to look at the various strategies that are available to help mitigate those taxes. So the next slide is showing the first example, which is a Roth conversion strategy. So Roth conversion strategy, the goal of that is to reduce the taxes that you're paying over your lifetime, and then to pass more tax-free assets onto your beneficiaries. So in this case, we're implementing a Roth conversion strategy over a 10-year period of time once that client is actually retired. And this results actually in a estimated lifetime tax savings of $309,000, because we're reducing those distributions out later on and we're keeping them in a lower tax bracket. But I think one of the most impactful pieces of this is that instead of the assets being passed to the beneficiaries in traditional IRAs, which with the Secure Act, these beneficiaries now need to withdraw all the funds from that IRA within a 10-year period of time and pay taxes at their highest tax bracket, you are now passing an estimated $3 million of assets in Roth IRAs. So not only are you saving $309,000 over your lifetime or the client's lifetime of tax savings, now their beneficiaries are going to receive over $3 million in Roth IRAs, which still need to be withdrawn within 10 years, but they are going to be tax-free withdrawals to the beneficiaries. So the next way to help mitigate your taxes during your lifetime are through qualified charitable distributions. So qualified charitable distributions are a great way to utilize your required minimum distribution and actually reduce your taxable income. The donations must be made to an eligible 501c3 organization. It may not be a private foundation. You can make donations to community foundations. And in fact, community foundations are a really popular choice because they can make a great lasting impact on your local communities. It's a distribution that with the donation to the community foundation, it can provide donors with an efficient way to support a variety of charitable causes. And those community foundations typically manage a variety of charitable funds, which can include donor advised funds, scholarship funds, endowment funds, and wide range of needs. And I know with Sharon and Lisa, you've got great resources there for help with that. But the qualified charitable donations, as I said, they count towards your required minimum distribution, and that distribution does not count as taxable income. You must be at least 70 and a half years of age on the day of the distribution, and the current maximum annual exclusion is $100,000 to be indexed for inflation. But keep in mind, when you're filing jointly, that spouse can also have a QCD and can exclude up to $100,000. So this next slide is showing the impact of the qualified charitable distribution. So if you take that same couple, instead of the Roth conversion strategy, you implement the qualified charitable distribution strategy. So this is starting at their age 73. You implement this strategy for 20 years using 100% of their required minimum distributions. And that estimated tax savings is now almost $1.5 million. And you can see that the taxes with the strategies are much lower. Of course, the taxes with the strategies much higher. And then the impact that you're making with those qualified charitable distributions is, it's really big. So let's shift gears and talk about preparing for retirement. So poll question, are you all set to retire? Or do you think your clients are all set to retire?
If she has anything available late this afternoon. Maybe.
I'm sorry, somebody has their speaker on. If they could mute that, that would be great.
I could do.
I think Sharon or Carmen, if you could mute somebody, that would be wonderful. I'm not sure who that is.
Thank you very much. I appreciate it. Thank you too.
Okay. So it looks like Roger has his voice on. If he could mute, that would be great. Okay. So anyway, I don't think there's a right or wrong. Well, let's see what the poll, how you all answered if you're all set to retire. Okay, no. So I think that this is pretty common. Retirement is up there with the stress of divorce, death, moving. And a lot of that is because people feel unprepared or they don't know how much they need. And so with our clients, we talk about, and the first thing we do when we work with them is actually develop a financial goal analysis. That financial goal analysis or that financial plan is going to help you reach your goals, which are, of course, first and foremost, don't run out of money before you pass away. You may have goals to establish a family legacy, charitable giving, some education planning. But having a written plan really gives you a measurable goal to work towards. And because you can track your progress, you can reduce the doubt or uncertainty that comes with those decisions. And we look at it as a living document that is updated at least on an annual basis, if not more frequently, as your life changes. And starting early and saving is really critical. Financial plan can help jumpstart savings, and even with a small amount of money, you have to start somewhere. So we kind of have our wealth management formula that we talk about, as I mentioned, or the process. And so with the lifetime financial planning, that's where we're going to take into account that cash flow planning, retirement planning, the goals. But then we also work with our clients on the advanced planning, and that's wealth protection with insurance, not just life insurance, but disability insurance, long-term care insurance, making sure they have enough property and casualty insurance in place. The wealth transfer and estate planning, we work very closely with estate planning attorneys and to make sure that that plan is in place and that it's implemented, whether through beneficiary changes or funding of trusts or insurance trusts. And then, of course, charitable giving is a big priority for our clients. So we work with them on the various strategies that are available to them. And then the wealth enhancement. So we talked about some of those strategies already. Relationship management, that's the relationship, of course, between ourselves and our clients, but more as important is the professional advisors like yourselves. And with the investment management, of course, every financial advisor does that, some differently than others. So that's really important to understand how the advisors are managing those assets. We manage our clients' assets according to the risk that they need to take, of course, with what their risk tolerance is as well. So this is the beginning of the financial goal analysis. And this is the kind of basic information that we are making sure we have as detailed as possible. So expenses is really the big one. So what do our clients need in order to maintain their current lifestyle or any lifestyle changes they want in retirement? So in this case, this is John and Jane, ages 63, 61. They need to maintain their lifestyle $125,000 net or cash a year. And we incorporate a 3.1% cost of living adjustment into that 125,000, with the exception of their mortgage, which does not have a cost of living adjustment. So this includes a mortgage reduction in the year 2025. They also want to travel, so we have a travel goal in there, and then John wants to purchase a boat when he retires. So you can see with the inflation on their goals that their expenses are going to increase over time. And so we want to make sure that they understand that as well. So then we look at their resources. Resources, of course, are going to include their 401ks. They've got some Roth IRAs. They've got taxable accounts. We're going to include their home as part of their net worth, not as a resource to fund their goals, and then their liabilities with the mortgage. So we look again at their resources. Over on the right-hand side, we're assigning a goal to those assets. So their investable assets are assets that you would use to draw income from are funding their goals. Their home is not. And then we also look at how much insurance they have. And so we can include that in the analysis. One input: while they are working, we are going to include the additions that they're making to any investment accounts. In this case, they're making them to their 401ks. And we also will take into account the employer contributions as well. They also are going to have some income sources, and in their case, they'll of course have Social Security. Social Security is a big question. It can be a swing of a couple $100,000 depending on when somebody takes that. So we want to make sure that we are running a Social Security maximization for them. And as of course they get closer to age 62, that becomes more relevant. But these clients are also going to receive pension income. So we include that into the plan, and if it has a survivor option or not. And then we look at how much risk they have. So in this client's case, we're looking at what we call a risk score 50. That's a 50% equity portfolio, 50% fixed income. And we are going to give an average return. This is based on historical capital market assumptions. And in this case, with that portfolio, we're estimating about 6.9% average return. That doesn't happen in a straight line, of course. And then we want to make sure that they understand what would happen to this portfolio if we went through another period of time like the Great Recession. So they understand that this portfolio could drop over $500,000, keeping in mind, of course, that these are losses on paper. You would stay invested for the long term. But we're going to take all of that information and we're going to run 1,000 scenarios based on all different types of markets. Good markets, bad markets, everything in between. And the goal of the plan, as I said before, is to make sure that they don't run out of money. So in this client's case, they are at 99%. So what does 99% means? That means that 99% of those 1,000 scenarios were positive. They were on track to reach their goals and they won't run out of money. Now, and for our purposes, you don't need to be at 99%. That tells us a couple of things. That first of all, you could retire earlier, you could spend more money, you could maybe take less risk or a combination thereof. So on the right-hand side, we show that if they were actually to spend over $2 million more during their lifetime, they're still in excellent shape. Now, there are cases, of course, where somebody has really nice, good resources, but they are spending way too much money. So we will then have to tell them, of course, that they need to maybe work longer, save more money, or maybe have a different type of portfolio to help those them when their needs. So every individual situation is different, but I encourage everybody to develop a financial plan. I don't really, I just can't stress that enough. I think it's so important. With the plan, it's a 100-page report. So there's, many details. And for those engineer types that want to see every nitty-gritty bit of the plan, there's more information than you probably need. But in this case, this is really nice, showing the year over year between the portfolio values, what you're adding to it, estimated investment earnings, and then what you end up each year. And it shows that at the end of this plan, there would still be almost $13 million that would be passed on to beneficiaries. So they could accelerate their charitable giving during their lifetime. They could accelerate their own spending, or a combination. So that's the end of my presentation. I hope that you found this information valuable. As I mentioned, there are a lot of changes with the Secure Act, so it's important to make sure that you're up to date on all of those numbers, and feel free to contact me as a resource. So now I will pass this along to Michael.
Thank you, Laurie. Had a couple of items I just wanted to go over concerning charitable contributions. One dealing with the qualified charitable distributions that Laurie discussed, the ability to, for somebody who's 70 and a half, to make a transfer out of their taxable IRA up to $100,000. In Connecticut, we get a real significant benefit from that because, of course, for Connecticut tax purposes, there is no itemized deduction. So if you were to take funds out and on a taxable method and then make a charitable contribution, you wouldn't get that benefit in Connecticut. So by effectively doing the qualified charitable distribution, you get the benefit of the charitable deduction by reducing your adjusted gross income, the item not being taxable, up to the 100,000. Plus, since it doesn't go into your adjusted gross income, there is certain potential federal benefits. I mean, items that are based on adjusted gross income, such as taxation of Social Security benefits, the net investment income tax, certain passive activity loss limitation rules, can be affected by the exclusion of this item from your otherwise taxable income. I think Laurie did mention the fact that it is potentially $100,000 per spouse if each spouse has a taxable IRA and each is 70 and a half. But you have to be concerned, or at least watch out, in the year that you turn 70 and a half. You can take advantage of a qualified charitable distribution, but only for the amounts that are distributed after you turn 70 and a half. So if you make a distribution before you turn 70 and a half, that doesn't get the benefit of the qualified charitable distribution rule. And generally, when you receive your 1099-R from the IRA administrator, you're not going to see the qualified charitable distribution noted. You get a 1099-R that shows that the distribution's been made, that it's taxable, and then you need to report it on your return as being, matching up to what the 1099-R says, but then showing QCD for qualified charitable distribution to say that it's non-taxable. If you have an inherited IRA, you can also take a benefit of this rule. So if you're the beneficiary of an inherited IRA, you can take advantage of the qualified charitable distribution, but only if you as a beneficiary are 70 and a half or older. So those were a couple of items I just wanted to go over concerning the operation of the qualified charitable distribution. in general, for charitable contributions, we have seen a trend with the IRS attacking very aggressively charitable contributions of property. And it's for wealthy individuals, the idea of transferring property to charities and being able to take a fair market value, higher fair market value deduction than its tax basis is a significant planning tool. However, the service has been extraordinarily aggressive in coming in and reviewing these contributions and disallowing them, even where there's no question of the fact that a transfer to the charity has been made. They'll admit that. There is no disagreement as to the value of the property that's been transferred. They'll agree on that. And there's testimony by the charity as to the facts that they received it. There were no quid pro quo arrangements, so that there would be nothing that would reduce the size of the charitable contribution. The IRS will still, the IRS would still come in and seek to deny the deduction in full because of lack of conforming to statutory and regulatory substantiation rules. Now, this will generally require the filing of a Form 8283 on the individual's tax return, and in certain circumstances, having to attach a qualified appraisal. The failure to report the information properly and to report all of the information that's required on the 8283 and or to attach failing to attach a qualified appraiser or having a qualified appraisal that doesn't satisfy all the regulatory requirements is enough for the service to come in and be willing to attack that contribution. And their attack is that you get a zero contribution deduction. I mean, there are various levels of contribution requirements. If you make a contribution of $250 or more, you're supposed to obtain a contemporaneous written acknowledgement from the charity that satisfies certain requirements. If the deduction is going to be more than $500, then you need to attach a Form 8283. And if the contributions are more than $5,000, in most circumstances, you then need to get a qualified appraisal. And at certain levels, you need to attach the qualified appraisal. You need to get the Form 8283 signed by the charity that received the contribution, by the qualified appraiser, and then attach it to the return. The 8283 requests a lot of information, including fair market value and tax basis. Now, even if you're going to make a contribution of property and take it based upon the value of the property contributed, and your tax basis has nothing to do with the contribution amount, by failing to supply that information, IRS says that they have not been provided information which, if they looked at the form, might give them a reason to question the contribution deduction. And they've been upheld in court on that. Courts generally say that there is no substantial compliance doctrine with respect to the substantiation rules. So you need to satisfy them, or else the deduction can be threatened in full. Unfortunately, I've been involved in referred many of these cases. In some circumstances, the service has a program ongoing, and the examiner you're dealing with will get a national consultant from National Office of IRS involved in the examination process. And they may just insist that the deduction is zero and force this to go to appeals or court in order to prevail. There is, under most circumstances, and contribution of property that would require the filing of 8283, a reasonable cause exception. So if you find yourself in a scenario where the service is looking to deny the deduction in full, and you can provide reasonable cause for it, and this is statutory, it's in the regulations, and it's in the IRS instructions, you can ultimately prevail by being able to assert reasonable cause. And we've been fairly successful in some circumstances where we've asserted reasonable cause, and generally it involves reliance on a tax professional, prepared the return, who didn't know of the requirement and didn't inform you as a contributor of the requirement. But you generally need something that supports that from the tax preparer, saying that they were at fault. It's just a very difficult area. You would think the service wouldn't be taking this tough an approach, because it disincentivizes making charitable contributions, and you think they would be doing everything they can in order to incentivize it. But this is unfortunately the situation we're in, and there were several cases that came down in 2022 where the service prevailed in this area. So we had one scenario where there were contributions of 92 separate items, all of which were documented and photographed and described in the qualified appraisal. The reference by the tax preparer was made to the qualified appraisal in terms of description of the items, and the service took the position that the 8283 was improperly prepared because each of the 92 items should have been disclosed as a separate item on the form 8283. And we're ultimately able to get the service to agree that common items can be grouped together, so their insistence of 92 items was incorrect. But in any event, there should have been commonly grouped items, which is more than a single item. And it raises questions, well, how do you determine in a mass asset that you might be separating certain aspects of, and again, contributing parts of, the basis with respect to each piece that's being contributed, if you have to disclose that information. So, I mean, it's an involved analysis, and it's become more and more prevalent. So if you plan on doing contributions of property, not marketable securities, and to that regard, service issued a chief counsel advice at the end of 22 that indicates that if you are contributing Bitcoin, that's considered to be property. So you can't just look to the listed price on the exchange. You need to get a qualified appraisal with respect to the transfer of Bitcoin, the same as if it were any other personal property that you were transferring. And with that, let's see, do we have any questions that came in?
Hi, it's Lisa Stanger. We do have a couple of questions. Thank you, Michael and Laurie. And we have a couple of questions from the presentations that I'm going to give you. And feel free to add additional questions. Participants, you could add those in the chat. So Laurie had mentioned that you will now be allowed to roll over monies from a 529 to a Roth IRA. And that it has to be the same beneficiary. And someone had a question about that, because you can use 529 monies for, let's say, a sibling of the beneficiary, or cousin of the beneficiary. Does that mean you can't do that in the case of the Roth IRA rollover?
So from our understanding, and of course, we'll wait to get more clarification on it, but the 529 plans would be rolled into the name of the beneficiary on the plan at that time. But you can change the beneficiaries, as they mentioned in that question. It could be changed to a sibling or a cousin. So, you know, it really depends on the whole situation. If there's no other children that would be benefiting from it, then, you know, I think it's kind of maybe a last resort.
Right.
Some people have multiple plans for different beneficiaries, so they would have the other assets, but yes, that's correct. It can be changed. Also can be used as an estate planning tool, because if you kept it in the name of that beneficiary, and let's say another generation happens, they've got children, you could actually change the beneficiary to that next generation and allow those assets to grow tax-free if they're used for educational purposes.
Right. Great. Thank you. Okay, another question. Currently, you cannot use a QCD towards a donor advised fund. we've heard over the years pushes to change that. We also know now a lot of people, or a number of people in Congress, aren't very hot about donor advised funds. So do you think that's something that on the horizon that you might be able to use all or part of a QCD towards a donor advised fund?
I'll let Michael take that.
Yeah, I mean, from the people that we speak to at national, our national organizations, it doesn't seem as if there's a great appetite for that. Essentially, the concern is that the donor advised funds for this purpose are kind of perceived to be similar to private foundations. You have control over where the fund is going. And so they were looking effectively for the QCD contribution to go to an organization or fund where you don't have that kind of control. So we're really not seeing movement in terms of being able to include donor advised funds. But you never know. It depends on who's in control of Congress at the time they get that piece of legislation on the table and what else is being negotiated against it.
Okay, great. One other question, and if anyone else wants to add a question, put it in now. If you had to advise a client, and recognizing I'm adding this in, different clients have different circumstances, but if they were choosing between donating appreciated stock or doing a QCD, and they couldn't do both, because of course I hear this and I'm like, oh, do a QCD for capital gifts and endowment funds and do stock for donor advised fund. But let's say they were choosing between one or the other. Which do you think is more beneficial to a client tax wise, making a gift of appreciated stock or doing a QCD rollover?
Michael, I would say you're the tax expert there. I would just say it's individual depending on the appreciation of the stock. But
yeah, I mean, I think you need to, well, as with all things tax, they're individual to a particular person's circumstances. So you can't really say there's one answer that's going to fit everybody's circumstances. But the thing is, with respect to appreciated property, you only get that benefit if it's eligible for long-term capital gain treatment, which is a preferentially taxed item. QCD is ordinary income. So what is your ordinary income rate versus your long-term capital gain rate? If your maximum bracket, you would think that the QCD would give you a better benefit than contributing the appreciated asset, particularly, and I know this is not the way anybody wants to think, but if you hold appreciated assets and you die holding them, under the current rules, which have been under attack consistently, they're stepped up basis, so that gain goes away. So, I mean, I think you need to model it out and to see where it goes, but I would think the QCD is the better solution in most cases than the transfer of the appreciated stock.
Thanks. And we just got another question coming in. Back to 529 rollovers to Roth IRAs. Subject to annual Roth limits, does this mean that the transfers from the 529 must be within the annual limit that can be added to a Roth? Whose limit applies there? For example, does a beneficiary have to have earned income in order to qualify for the Roth contribution from the 529?
Okay. We're waiting for guidance on all of that.
yeah.
You know, and that's not a this year issue anyhow.
Mhm.
So I'm sure the guidance will be issued, but based upon our reading of the statute, it's going to be the beneficiaries
Mhm.
Okay,
would be the person that would whose limits would apply.
great. Thank you. And that is it right now for questions. If anyone wants to add anything else, or Michael and Laurie, thank you so much. Do you want to add anything?
No, other than thank you for having us, and I hope that you found the information valuable. And I think, contacting Michael or myself with any further questions, feel free.
Thank you. I'm now going to turn it over, I think, Sharon Closius from the Valley Community Foundation.
Yes. Hi, everybody. And I want to thank you again for joining us. And I want to thank Laurie and Michael for their wonderful presentation. It gives a lot to think about, especially when you're turning my age and saying, okay, what are we going to be doing here? So I thank you so much for all your education that you shared with us. And I want to inform everybody that this was recorded. The webinar is recorded, and we're going to share it with you within the next week. And I believe Laurie, you're going to be sharing your slide deck. Is that right?
Yes, that's right.
That will be coming out as well. And we're going to be sending out an evaluation. So I hope everybody will put in their comments in the evaluation and tell us more about what you would like to learn from us. So we gave you guys back another 10 minutes of your day. So thank you so much for coming, and we will see you again.
All right. Thanks, everyone. Take care.
Thank you.